in the policy conference and in the international symposium, she has helped 𝐒𝐈 connect with leading economists and policymakers across Europe. Yale's deep network and international perspective have been invaluable in broadening 𝐒𝐈's reach and fostering meaningful global dialogue among economists. And finally, Julia Coronado, founder of Macro Policy Perspectives, who has been a true cornerstone of 𝐒𝐈's leadership for the past decade. Julia has served 7 years on the board, including as president and most recently as past president. Her macroeconomic expertise, her mentorship, expansive network have all shaped countless 𝐒𝐈 programs and surveys and helped advance the CBE program. So on behalf of all of 𝐒𝐈, I want to thank 𝐂𝐴. Thank you, Kathleen, Yale, and Julia for your service, for your leadership, and for your lasting contributions to our community. And not last contributions, but lasting, because I know you're not quite going anywhere, just rolling off the board.
Jokes are coming.
So if you could please come up and we will, I think, do a quick picture. Your plaques have not arrived, unfortunately.
Supply chain issues.
Shout out to the 𝐒𝐈, the National Association for Business Economics. I was saying that wrong earlier. I was saying of business and economics. For business economics, very specific. Chair Powell is supposed to speak at this luncheon, and specifically, he is giving the Adam Scott. Oh God, no, it's not Adam Scott. Adams something award lecture on business economics. I tried to get a feed of this all last night. I wrote to 𝐒𝐈, I emailed them, I tried to get them on Twitter, on their socials. It's impossible. They have a phone number. Their phone number, you call it, it just goes to like a default voicemail where it's like, this number, it's like, you've reached, it's like that lady's voice, and it's like, you've reached the business of economics of beep, and like you leave a message. So could not find it, and then I don't know, I was about to cancel this. I told you guys if we couldn't find a feed, we would ditch it. And then I noticed it's like NBC had a feed. NBC, I don't know. CNBC, one of those. Associated Press had a feed. I don't know. I wrote them and asked them if I could pay for a virtual ticket to stream it. If, whatever. They didn't get back to me. So I didn't want to buy a ticket and then stream it without their permission. Now that I see many channels doing this, I feel like it's okay. We're actually streaming CNBC TV 18. Shout out to CNBC TV 18. They've got 800 viewers. Come on over to ours. You guys go over there. Tell them come over here. Shout out to them. So we're watching their stream, and we're streaming it while they stream Nab's stream. You can see source down here. So yeah, he is supposed to be live like now. I think. Actually, I did all the research on this. I looked everything up. And I almost considered just driving there. Like taking a train and like going there. Taking like a day trip over there. Because I could get there not so... wouldn't take me that long. But they are just
in addition to
going
service?
into whatever. They're going into these awards that we're not really familiar with. Where's the schedule? I just had it. This is the 67th meeting. Chair Powell is a speaker. Sponsored by Intuit, Fidelity, Peter G. Peterson's, Parthenon, Haver Analytics, KPMG, Kinsley Global, Wells Fargo, Economist Intelligence, and Morgan Stanley, Bloomberg, MetLife, S&P Global, Wood, Pool, and more. Just get their sponsors out of the way. Program is... So he's supposed to speak, I thought it was at 11:10. Here's the thing, this is kind of an odd time slot, I want to say, for Chair Powell. Yeah, what's up, new subscriber? Welcome, friends. It's kind of a weird time slot. So the time slot that he is in is the Adam Smith Award Luncheon and Lecture. So the lecture is going to be by Powell. The time for this is 11:30 a.m. to 1:10 p.m. There is a lecture, but then there's also a moderator. Emily Kolinsky-Morris, who is the 𝐒𝐈 president, chief economist, Ford Motor Company. So there's a moderator. So I wonder if maybe there's other panelists. It doesn't have anyone else here. It doesn't say anyone else is talking. It seems odd to have a moderator if it's just Powell speaking. I'm not really sure what to expect here. I'm not totally sure. Is it fair use? I don't know. I don't know. Who knows? Who knows? Certainly am not trying to distribute this in any kind of way. Maybe I'll turn monetization off for the stream. Not that that will do anything, but like maybe just to, keep my things in line. Let's just turn that off. We'll go ahead, turn that one off. And I'm going to ask for forgiveness. I did reach out to them. I did make many attempts, and I was going to throw in the towel. I wasn't going to just stream it. I wasn't just going to buy a $500 ticket and stream it without their permission. But I saw many channels have it up. They have this feed, so yeah, we'll see. We'll see how it goes. Hopefully we're good. Hopefully. So we got Bitcoin up on the stream, up on the screen. We got the dollar down below. What do we got going on? This is the last FOMC setup. What do we got here? Dollar flirting with 100. Bitcoin, just in time, holding the low. 109.7. Little reversal here. No real change in price. We talked about this yesterday. I'm not really used to having streamed the day before. Talked about this yesterday. I think someone was saying, "Oh, are we seeing a bull flag? We're seeing this or that." I said, honestly, what we're probably gonna see is this. We're probably gonna see, and I might have had it this way at the time. We're probably going to see a bear flag. That bear flag is likely when that breakouts, fake breaks to the upside and downside. And in hindsight, it will just be a larger and larger flag, right? Our highs coming down, our lows coming up. This is exactly what we saw back in August, right? Is it August? What was I looking at? Farther back. Let me see who's speaking. Nope, just another guy. Shout out to this guy, though. These are the award winners. This is exactly the kind of price action we saw back here in August on our sell-off. We said this is very similar looking. Basically a bear flag. Oh.
Here we go. Thank you very much.
There's Powell.
We got a camera somewhere?
I thought we did, but maybe not.
There we go. We don't
They're
have a
giving
camera.
him an award. Probably
There
for
we go.
handsomest guy. Yeah. I don't know what's going on here. I guess he gets an award. I thought he was given the lecture.
Thank you. Thank you so much.
That's the pace of these things. They can change on a dime. Here we go. Let me make sure the volume's good. Weirdly silent. Did they replace Powell with AI? Did you just see that? He just teleported around. By the way, guys, when we have a second, I guess he's getting his notes.
Thank
Make
you,
sure to
Emily.
smash the likes,
And thanks to
subscribe,
the National
type up.
Association for Business Economics for the Adam Smith Award. It, for me, is an unexpected honor just to be mentioned alongside many of your past recipients, including particularly my predecessors, Janet Yellen and Ben Bernanke. So thank you very much for this recognition.
Thank you, sir, for your...
I will say on a more personal note, I have greatly enjoyed my regular visits to your annual meeting and your conferences. It's really been my favorite venue all these years. It's a place.
The place, indeed it is. Indeed it is a place.
This is a place where we can talk about economic issues and not worry that someone's eyes might glaze over.
Mm-hmm.
I also appreciate the warm welcome I've always received here. And putting Fed staff aside for a minute, I can't think of a more lovable group of econ nerds anywhere.
Talking about you guys. Talking about everybody out there. The audio is a little disconnected. I assume they just have bad audio, as seemingly
So
all
thank
these
you again
places
for this prestigious award.
You earned it.
And for the opportunity to speak to you here today. So, as we all know, monetary policy is more effective when the public understands what the Federal Reserve does and why. With that in mind, I hope to enhance understanding of one of the more arcane and technical aspects of monetary policy, the Federal Reserve's balance sheet. A colleague recently compared this topic to a trip to the dentist, but I found that comparison somewhat unfair to dentists.
Hey,
So today I'll discuss the
Hey,
essential role that our
jokes.
balance sheet
That's the
played
Powell
during the
we know.
pandemic,
that's the
along with
Powell
some
we
lessons
know.
learned. I'll then review our ample reserves implementation framework and the progress we've made toward normalizing the size of our balance sheet. And I'll conclude with some brief remarks on the economic outlook. So, one of the primary purposes of a central bank is to provide the monetary foundation for the financial system and the broader economy. This foundation is made of central bank liabilities. On the Fed's balance sheet, the liability side of the ledger totaled $6.5 trillion as of October 8, and three categories account for roughly 95% of the total. First, Federal Reserve notes, that is physical currency, totaled $2.4 trillion. Second, reserves, funds held by depository institutions at Federal Reserve banks, totaled $3 trillion. These deposits allow commercial banks to make and receive payments and meet regulatory requirements. Reserves are the safest and most liquid asset in the financial system, and only the Fed can create them. The adequate provision of reserves is essential to the safety and soundness of our banking system, the resilience and efficiency of our payment system, and ultimately the stability of our economy. Third is the Treasury General Account, or TGA, currently at about $800 billion, which is essentially the checking account for the federal government. When the Treasury makes or receives payments, those flows affect dollar for dollar the supply of reserves or other liabilities in the system. The asset side of our ledger consists almost entirely of securities, including $4.2 trillion of U.S. Treasury securities and $2.1 trillion of government-guaranteed agency mortgage-backed securities, or MBS. When we add reserves to the system, we generally do so by purchasing Treasury securities in the open market and crediting the reserve accounts of the banks involved in the transaction with the seller. This process effectively transforms securities held by the public into reserves, but does not change the total amount of government liabilities held by the public. So, the Fed's balance sheet serves as a critical policy tool, especially when the policy rate is constrained by the effective lower bound, or ELB. When COVID-19 struck in March 2020, the economy came to a near standstill and financial markets seized up, threatening to transform a public health crisis into a severe economic downturn. In response, we established a number of emergency liquidity facilities. Those programs, supported at the time by the administration, provided critical support to markets and were remarkably effective in restoring confidence and stability. At their peak in July 2020, loans from these facilities totaled just over $200 billion. Most of these loans were quickly unwound as conditions stabilized. At the same time, the market for U.S. Treasury securities, normally the deepest and most liquid market in the world and the bedrock of the global financial system, was under extraordinary pressure and on the verge of collapse. We used large-scale purchases of securities to restore functionality to the Treasury market. Faced with unprecedented market dysfunction, the Fed purchased Treasury and agency securities at an extraordinary pace in March and April of 2020. These purchases supported the flow of credit to households and businesses and fostered more accommodative financial conditions to support the recovery of the economy when it ultimately came. This source of policy accommodation was particularly important as we had already lowered the federal funds rate close to zero and expected that it would remain there for some time. By June 2020, we slowed our purchase pace to a still substantial $120 billion per month. And in December of 2020, as the economic outlook remained highly uncertain, the FOMC said that we expected to maintain that pace of purchases until substantial further progress has been made toward the committee's maximum employment and price stability goals.
This isn't a nothing.
That guidance provided assurance that the Fed would not prematurely withdraw support while the economic recovery remained fragile amid unprecedented conditions.
That Powell has been,
and we maintained that pace of asset purchases through October 2021. By then, it had become apparent that elevated inflation was not likely to go away without a strong monetary response. At our meeting in November 2021, we announced a phase out of our purchases. And at our next meeting in December, we doubled the pace of that taper and said that asset purchases would conclude by mid-March of 2022. Over the entire period of purchases, our securities holdings increased by $4.6 trillion. So a number of observers have raised questions, fairly enough, about the size and composition of asset purchases during the pandemic recovery.
I was wondering.
Throughout 2020 and 21, the economy continued to face significant challenges as successive waves of COVID caused widespread disruption and loss. During that tumultuous period, we continued to purchase in order to avoid a sharp, unwelcome tightening of financial conditions at a time when the economy still appeared to be highly vulnerable. Our thinking was was informed by recent episodes in which signals about reducing the balance sheet had triggered significant tightening in financial conditions. And we were thinking of the events of December 2018, as well as the 2013 taper tantrum.
Taper tantrum.
Regarding the composition of our
laugh.
purchases,
Didn't get a laugh,
some have
though.
questioned the inclusion of agency MBS purchases given the strong housing market during the pandemic
This
recovery.
speech is live right now.
Outside
by
of purchases
AI
aimed specifically
Powell.
at market functioning, MBS purchases
Yeah, I
are
got
primarily
boo-boos.
intended,
It's just
like
dry
our
skin.
purchases of Treasury securities, to ease broader financial conditions when the policy rate is constrained by the effective lower bound. The extent to which these MBS purchases disproportionately affected housing market conditions during that period is challenging to determine. Many factors affect the mortgage market, and many factors beyond the mortgage market affect supply and demand in the broader housing
What
market.
is going on here? Look at
With the clarity of hindsight, we could have and perhaps should have stopped asset purchases sooner. Our real-time decisions were intended to serve as insurance against downside risks. We knew that we could unwind purchases relatively quickly once we ended them, which is exactly what we did. Research and experience tell us that asset purchases affect the economy through expectations regarding the future size and duration of our balance sheet, so that when we announced our taper, market participants began pricing in its effects, pulling forward the tightening in financial conditions. Stopping sooner could have made some difference, but not likely enough to fundamentally alter the trajectory of the economy. Nonetheless, our experience since 2020 does suggest that we can be more nimble in our use of the balance sheet and more confident that our communications will foster appropriate expectations among market participants, given their growing experience with these tools. Some have also argued that we could have better explained the purpose of asset purchases in real time.
This could have been like
there's always room for improved communication, but I believe our statements were reasonably clear about our objectives, which were to support and then sustain smooth market functioning and to help foster accommodative financial conditions. Over time, the relative importance of those objectives evolved with economic conditions, but the objectives were never in conflict. So at the time, this issue appeared to be a distinction without much of a difference. That's not always the case, of course. For example, the March 2023 banking stress led to a sizable increase in our balance sheet through lending operations. We clearly differentiated these financial stability operations from our monetary policy stance. Indeed, we continued to raise the policy rate through that time. Turning to my second topic. Pardon me.
What was your first topic,
Our
bro?
ample reserves regime has proven highly effective, delivering good control of our policy rate across a wide range of challenging economic conditions, while promoting financial stability and supporting a resilient payment system. In this framework, an ample supply of reserves ensures adequate liquidity in the banking system, and control of our policy rate is achieved through the setting of our administered rates, interest on reserve balances, and the overnight repurchase rate. Reverse repo rate, rather. This approach allows us to maintain rate control independently of the size of our balance sheet. And that's important given large unpredictable swings in liquidity demand from the private sector and significant fluctuations in the autonomous factors affecting reserve supply, such as the TGA. This framework has proved resilient whether the balance sheet is shrinking or growing. Since June 2022, we've reduced the size of our balance sheet by $2.2 trillion, from 35% to just under 22% of GDP, while maintaining effective interest rate control. Our long-stated plan is to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserves conditions. We may approach that point in coming months, and we are closely monitoring a wide range of indicators to inform this decision. Some signs have begun to emerge that liquidity conditions are gradually tightening, including a general firming of repo rates, along with more noticeable but temporary pressures on selected dates. The committee's plans lay out a deliberately cautious approach to avoid the kind of money market strains experienced in September 2019. Moreover, the tools of our implementation framework, including the standing repo facility and the discount window, will help contain funding pressures and keep the federal funds rate within our target range through this transition to lower reserve levels. Normalizing the size of our balance sheet does not mean going back to the balance sheet we had before the pandemic. In the longer run, the size of our balance sheet is determined by the public's demand for our liabilities, rather than by our pandemic-related asset purchases. Non-reserve liabilities currently stand about $1.1 trillion higher than just prior to the pandemic, thus requiring that our securities holdings be equally higher. Demand for reserves has risen as well, in part reflecting the growth of the banking system and the overall economy. Regarding the composition of our securities portfolio, relative to the outstanding universe of Treasury securities, our portfolio is currently overweight longer-term securities and underweight shorter-term securities. The longer-run composition will be a topic of committee discussion. Transition to our desired composition will occur gradually and predictably, giving market participants time to adjust and minimizing the risk of market disruption. Consistent with our longstanding guidance, we aim for a portfolio consisting primarily of Treasury securities over the longer run. Some have questioned whether the interest we pay on reserves is costly to taxpayers. In fact, that is not the case. The Fed earns interest income from Treasury securities that back reserves. Most of the time, our interest earnings from Treasury holdings more than cover the interest paid on reserves, generating significant remittances to the Treasury. By law, we remit all profits to the Treasury after covering expenses. And since 2008, even after accounting for the recent period of negative net income, our total remittances to Treasury have totaled more than $900 billion. While our net interest income has temporarily been negative due to the rapid rise in policy rates to control inflation, this is highly unusual. Our net income will soon turn positive again, as it typically has been throughout our history. Of course, having negative net income has no bearing at all on our ability to conduct monetary policy or meet our financial obligations. If our ability to pay interest on reserves and other liabilities were eliminated, the Fed would lose control over rates. The stance of monetary policy would no longer be appropriately calibrated to economic conditions and would push the economy away from our employment and price stability goals. To restore rate control, large sales of securities over a short period of time would be needed to shrink our balance sheet and the quantity of reserves in the system. The volume and speed of these sales could strain Treasury market functioning and compromise financial stability. Market participants would need to absorb the sales of Treasury securities and agency MBS, which would put upward pressure on the entire yield curve, raising borrowing costs for the Treasury and private sector. Even after that volatile and disruptive process, the banking system would be less resilient and more vulnerable to liquidity shocks.
What up, Juan? How you doing, bro?
The bottom line is that our ample reserves regime has proven remarkably effective for implementing monetary policy and supporting economic and financial stability. So I will close with a brief discussion of the economy and the outlook for monetary policy.
Okay, this
Although some important government data have been delayed due to the shutdown, we routinely review a wide variety of public and private sector data that have remained available. We also maintain a nationwide network of contacts through the reserve banks who provide valuable insights, which will be summarized in tomorrow's Beige Book.
The Beige Book.
Based on the data we do have, it's fair to say that the outlook for employment and inflation does not appear to have changed much since our September meeting 4 weeks ago. Data available prior to the shutdown, however, show that growth in economic activity may be on a somewhat firmer trajectory than expected. While the unemployment rate remained low through August, payroll gains have slowed sharply, likely in part due to a decline in labor force growth due to lower immigration and lower labor force participation. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. While official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue their downward trajectories. Meanwhile, 12-month core PCE inflation was 2.9% in August, up slightly from earlier this year, as rising core goods inflation has outpaced continued disinflation in housing services. Available data and surveys continue to show that goods price increases primarily reflect tariffs rather than broader inflationary pressures. Consistent with these effects, near-term inflation expectations have generally increased this year, while most longer-term expectation measures remain aligned with our 2% goal. Rising downside risks to employment have shifted our assessment of the balance of risks. As a result, we judged it appropriate to take another step toward a more neutral policy stance at our September meeting. There is no risk-free path for policy as we navigate the tension between our employment and inflation goals. This challenge was evident in the dispersion of committee participants' projections at the September meeting. And I'll stress again that these projections should be understood as representing a range of potential outcomes whose probabilities evolve as new information informs our meeting-by-meeting approach to policymaking. We'll set policy based on the evolution of the economic outlook and the balance of risks rather than following a predetermined path. And with that, thank you again for this wonderful award and for inviting me here today. I look forward to our discussion. Thank you.
Ooh, there is a discussion. So we've never heard Powell speak that long, like in that kind of block sentence.
No, I didn't.
Okay, yeah, they're going into like an interview format. Let's go. There's more. And just when you thought it was over, there's more.
Thank you, Chair Powell, for the excellent remarks
Honestly,
in the
this is
Adam
where it gets
Smith
good
address. And we will have about half an hour for
That's
questions.
the right
So
amount.
Like a long
should
time.
have talked longer.
That's an eternity in Powell time. This is the real resolution.
So
of their
let me
feed.
start with, before I go to some of the
That's
questions
impressive.
coming in from the audience, and do use the Connect app to generate those. You have said, and you repeated again here, that there are no risk-free
This is at all-time
paths
high.
for the Fed now. So in light of that, and in particular, with where the recent inflation data are running, let me group this with some of the questions that we're seeing coming in on the app as well. Obviously, always data dependent. But thinking about the dual mandate of maximum employment and price stability, how concerned are you that if the rate of pass-through of tariffs is slower, that might begin to look like more persistent inflation as opposed to a one-time, as if the tariff adjustment came through all at once, and then it would be quite clearly a one-time price level shift?
So that's certainly a risk. As I mentioned, there really isn't a risk-free path now since it appears that inflation is running above our target and appears to be continuing to increase quite gradually, but increase. It's still on the way up.
We never got
so there's a risk there that would lend to greater persistence. But now the labor market has demonstrated pretty significant downside risks as payroll jobs have declined, and both the supply and demand for labor has declined quite sharply. So those two states of affairs for our two goal variables call for different monetary policy responses. So as they come more into balance, I think the idea has been that policy should move from being tight to some degree to being more neutral as those two things balance out. But it is clear though that if we move too quickly, then we may leave the inflation job unfinished and have to come back later and finish it. And if we move too slowly, there may be unnecessary losses, painful losses in the employment market. So we're in the difficult situation of balancing those two things. I think for the last few months, we've been able to maintain a restrictive stance because the labor market was still pretty solid. I think that the data we got right after the July meeting showed that which adjusted back all the way through May, showed that the labor market has actually softened pretty considerably and puts us in a situation where the two risks are closer to being in balance.
Let's move to the other risk then,
Gina,
and talk
the
about
other risk?
employment a little bit.
Not enough Gina.
We had
Gina
Anna
bear
Paulson here
market.
yesterday, and she spoke about the break-even unemployment, or break-even employment growth rate. And that's a question from the audience as well. So I believe she said that it's certainly lower than it was, and the standard error around those estimates probably includes some numbers that might even be negative. Where do you see the monthly break-even employment growth rate at this point?
I'm not going to try to give you a pinpoint number, but as you pointed out, the standard error around these things is 50,000 plus or minus, something like that. And that would certainly, I think the range of plausible numbers for the break-even rate is probably does go below zero, accounting for those standard errors. It's clearly come down a great deal. And that's what's so challenging about this is that both supply and demand in the labor market have come down so sharply, so quickly. And the fact that the unemployment rate has barely moved is kind of remarkable in and of itself, and suggests that they're moving at roughly the same pace. Although, of course, the unemployment rate has ticked up, which suggests that demand is moving a little faster than supply. I wouldn't want to point to a specific number other than to say that it's come way down. And there are many estimates out there. By the way, there are many ways to calculate it, so you're going to get different estimates.
We're certainly in a volatile and changing environment. So one question I have is whether you see any changes in the transmission mechanism of monetary policy actions. So when we speak of long and variable lags, as we do, are those changing? And in particular, do you think there might be any difference in the impacts of policy on inflation versus employment? Is one changing more than the other?
That's like 2 or 3 questions, so I might have to come back to you. That's right.
Glitching.
So on transmission, there, in theory at least, I see 2 things. One is, what we say and the actions that we take on monetary policy and how quickly that gets into financial markets. So if you go back to when I was in college, that part would have taken, weeks, months, probably. And now that part happens essentially instantaneously. But the rest of it, once it's in the financial markets, how quickly does it affect economic activity, unemployment, employment, inflation, et cetera? I think that's more dependent on the conditions in the economy. For example, if you take the group of people who had extremely low rate mortgages, right? And even so, if you can cut rates, but they're a long way down, and they're sort of in a place where it's going to be expensive to move and to take out a much higher rate mortgage, even assuming significant numbers of cuts. So that has probably blunted the transmission of lower rates into that part of the economy. But overall, I think it still works the way we think it works, which is, long and variable lags means a lot of uncertainty about how it's being affected. I think the last part of your question, the lore has been that inflation and employment come later.
Dude, he's glitching.
The first decisions are purchasing decisions, hiring decisions, and things. Well, purchasing decisions, can be affected probably more quickly. But then those would eventually affect employment and inflation. So longer lags are when the research generally shows longer and longer lags for employment and inflation.
And I guess the variable part of that comment does give us a bit of cover.
A lot of uncertainty.
So you spoke about the adjustments or the challenges that you're facing with some government data not currently being published. Beyond the headline unemployment rate, which we're not going to see right away, what other labor market indicators are you monitoring most closely to gauge that side of the mandate?
So I think everyone's looking at the same non-government data. So there's a set of non-government data around, or non-federal government data around labor markets. For example, state level unemployment, claim reports. You can add those up and get a pretty decent estimate, and that's a really good one. There's also ADP has its data and employment. So in the employment space, there's some plausible data. I will say generally the private data, the alternative data that we look at, is better used as a supplement for the underlying governmental data, which is the gold standard, and it won't be as effective as the main course as it would have been as a supplement. So we don't expect that we'd be able to replace the data we're not getting. So I think in job, in employment space, there's some pretty good substitutes, less so in inflation space and in economic activity space. And also they're just, there are different private data providers use different universes and different levels of rigor in their data analysis. So, we're looking at lots of things, and we're going to make our decisions according to the FOMC schedule. But I think it will be a lot better once we start getting, for example, the September employment report is going to be a very important report, And we're not on track to have that. There would still be time for us to get that. We will get, of course, the September inflation, the CPI and PPI reports. So that's a positive. But we don't comment on fiscal matters, but from our standpoint,
don't comment on
we'll start to miss that data, and particularly the October data. If this goes on for a while, they won't be collecting it, and it could become more challenging.
You used the term gold standard, and you didn't mean it in this context, but I'm going to pivot here because there's a question from the audience that's getting a lot of upvotes. So one of your predecessors, Alan Greenspan, used to view the price of gold as an indicator of inflation risk. So in that context, how do you view the rally that we've seen in gold? And if you want to throw in Bitcoin, you can comment on that too.
I'm not going to comment on any particular asset price, including that one. And I think we think of inflation as driven by fundamental supply and demand factors, and it's not something we look at actively.
Fair. The September projections, we saw revised GDP growth projections revised upward for both 2025 and 2026. Now, sometimes it's just an issue to issue thing, but how do you reconcile that projection of stronger growth with what we're seeing in terms of a likely weakening labor market?
So even subsequent to the September SEP, we've seen economic activity data which are surprising to the upside. And as I mentioned in my remarks, so you do have a bit of a tension there between the labor market data that we see, very low levels of job creation, and yet people are spending. So economic activity is strong, and it's we're going to have to see how that plays out. Right now, of course, we're not getting any new government data on that, any new federal government data on that, but it does create, of course, if economic activity were stronger, then that would tend to support labor market activities and hiring.
Bitcoin looks like it's reversing.
And so we'll have to see how that works out.
I forgot the government
another
shut
topic
down.
that has permeated the conference over the last 2 days has been AI. So as the Federal Reserve, like all of us, grapple with the implications of generative AI.
And how it could be perhaps the federal chairman.
Activity, implications for labor markets and overall economic stability. And does that present any new risks to
spaghetti recipe,
monetary policy or financial stability?
So you're right. We're doing what other people are doing, which is reading all the things that, so many researchers are working on AI now. It's just amazing. And so we follow all of that. We also have people at the Fed who are doing lots and lots of research on AI. And, in terms of, it's just such early days to be looking for the kind of things that will happen. So, the question of productivity, it was Robert Solow who said that technology showing up everywhere, but in the productivity data. So this could be the same kind of thing where it's there, but it takes a long time kind of to show itself, because you would think of another big technological advance as potentially raising productivity, but I think it's early to say that we're seeing it. Also, you're seeing, I think some researchers have found effects on hiring from AI for entry-level people and for coders and things like that. So there's probably some of that out there, but it's just so early to say what it will be. We also monitor very carefully what public companies are saying. Increasingly bold statements from mainly large private companies on things that they think they can do across their whole business area with AI, and either sort of freeze hiring where it is or reduce hiring. And I think we're pretty aware of what the potential outcomes are, but the range of potential outcomes is very broad. I will say, in terms of what the Fed can do, we deal with supply and demand. We have an interest rate, and we also do regulation, that kind of thing. But if what's needed is greater education and skills, I've always liked the model that technology can work for everybody as long as everybody's getting the skills and aptitudes they need to use that technology. This is Golden and Katz, their work, which they actually spoke about at Jackson Hole this year, but it's a 20-year-old book that they wrote. So we can't do that. That's not something the Fed can do. we also can't address the potential societal disruptions that could happen, potentially, if there's really significant job loss. So there are a lot of, we're the least of it. There are potentially really significant implications for people in the labor force. And I think we're all speculating about what those might be, but it's only the beginning of this story.
Yeah. Looking at some of the other questions that are getting upvoted, and you can get as far into the weeds as you want, but this is where people want to go. So let me try this one. As you think of the appropriate level of reserves in the system, what indicators are most important? Is it the price of money, so repo levels, or the volume of borrowings from the Fed, like the discount window,
is AI,
and so on?
So we have a nice spider chart and a 5 main indicators, one of which is sort of repo levels.
One of which
and I think
RSI.
Overall, what they're showing is that we're still at ample reserves. Abundant reserves. We're still at abundant reserves, meaning above our goal of ample reserves, a little bit above ample reserves. So, but we're beginning to see, you're starting to see a little bit of tightening in money market conditions, particularly repo rates have moved up. And those are the things we're going to be watching. So we think we're still at abundant, and we're, the pace of runoff is now very, very slow. So we're going to be watching all those factors very carefully. And we're not so far away now, but there's a ways to go.
I think we're not going to get away without addressing this one. So I'll try to, again, group some of these together. First, there's definitely appreciation from the audience, your ability to try to remain above the political fray. And I think also, and as in your remarks, you said gradually and predictably, and that sounds really nice right about now. But with that ongoing scrutiny of the policy decisions of the Fed, what measures is the Federal Reserve taking, and are you taking, to ensure and demonstrate the continued independence in setting monetary policy?
So the main thing we can continue to do is to do our work the way we've always done it, which is, think really carefully about evolving economic conditions and the evolving outlook and the balance of risks, and try to make good decisions to best serve, the American public. And then explain those decisions and talk about them in a way that makes sense and is grounded in the data and our overall approach. I think we're going to keep doing that. And as long as we're doing that, people will be able to tell. If we start doing something else, I think people will be able to tell that too. But that's just not something we're ever going to do. We're always going to keep doing our work. We don't engage in back and forth with people. It's just not that gets to be political sort of right away. So we just do our work and do it as best we can. Overall, I would say the Fed comes through the last, if you think about it, go back to the beginning of the global financial crisis. We've had 2 world historical crises back to back, essentially. And the U.S. economy, it's been quite a ride for the U.S. economy and for American citizens, but we've come through it as well or better than any other country in the world. And we had to innovate.
We did great.
And did innovate. There was really no choice. We can look back now and as I did today and second guess ourselves, which is only appropriate. That we've been doing it for 10 years. Since I got to the Fed 12 years ago, we were already doing a lot of that. So that's an ongoing process. But I think
the best.
If you take a step back, the Fed isn't a government agency that does a good job for the public that it serves, and that is our only goal. And I think we do it pretty well. Don't look for perfection. These are close calls that have to be made in real time. But I guess that's what I would say.
It's fantastic. And in that context, then internally to the FOMC, how important is it that you have consensus on it? We're economists. We understand the value of spirited debate, but is that important in terms of communicating the results and the decisions of the committee?
Consensus is great, but the most important thing of all is to get it right. And that you come to places, not very commonly, but sometimes you come to places where people are going to have different views, and this is one of them. You have a situation here where literally inflation's above target and gently rising. the labor market is subject to pretty clear downside risks. What do you do? How do you think about that? That's not a problem that you face very often in central banking or in the economy. And people are going to have different weights and different risk aversion and different risk appetites on those things. It would be kind of surprising if you had no debate over those things. So we have a healthy debate going. I think it's very healthy. I think the meetings that we've been having are as good as any we've had, in terms of people sincerely, giving their absolute best argument for their positions, but they're different positions. That's, I mean, when I was an investor, I always felt like the most dangerous thing is if everybody agreed on something, because you need someone to come in and try to explain why this is a terrible idea. Hopefully somebody really smart. And that would give you the ability to really test your thinking. So I think that's a healthy discussion that we're having right now. And I'm not at all surprised that we have people across the board. I do think we also, as an institution, do try to come together around a central answer. And that's, of course, part of what I try to do is find an answer that will attract as much support as possible.
Absolutely.
Yeah, you just
I know you probably won't want to comment in great detail on global conditions, but there are a few questions around that and what that implies for U.S. monetary policy, and also just looking at the interest rate differentials between the U.S. and other advanced economies, and how long that could persist, and is there a risk there?
Sorry,
the interest rate differentials between the U.S. and other advanced economies.
Yeah, I mean, we set interest rates according to, the place where our economy is domestically, taking into account the international aspects of our economy. So again, it's not surprising. I mean, you could name many, many factors, but, for example, tariffs are clearly more disinflationary for countries that are subjected to them, and they're more, I won't say heavily inflationary, but there's some inflationary pass-through to consumers from countries that are putting tariffs on. So there's a very different monetary policy response potentially just in that. So, I think we need to set, as every other central bank does, they're setting rates in whatever their remit is geographically, and they're going to be different answers. It's not unusual.
So we have a large number of young economists in the audience today. Could you talk a little bit about, as we look back and,
some not so young.
It's a momentous award. It's a nice time to reflect. If you looked back on your early career and your early goals, how do you think that young Jerome Powell would view where Jerome Powell is sitting today as chair of the Federal Reserve?
Surprised.
True.
No, I would say, so what I would tell young economists is you've chosen a great profession, a tremendous profession. You're getting the tools to analyze public policy and what works and what doesn't work and what should be expected to work and wouldn't and why. And also what's the state of the economy. And guess what? It's not just hard, it's basically impossible, but it's a very, very difficult thing, but it yields itself up over time. And it's just an incredibly important subject that carries the capability to do really good things for the general public, who may not feel great gratitude toward economists, but sometimes. But no, it's a really important. You've made a great choice, and I would say wish you the best of luck.
Thank you. Agree.
Agreed.
Okay, we'll do a little bit of a lightning round here. We have about 5 minutes left, so I'll ask a bunch of questions that
the audio
that
is totally desynced from the video.
Want to get into great detail on anyway.
Not even close.
Yeah. So some of these are pretty straightforward. But so we talked quite a bit about labor markets, but we have not specifically asked the question about the effect of immigration policies on labor supply. How restrictive do you think that current policy is, and is that something that will just
current immigration policy?
Yeah.
Yes. Let me start by saying that we don't have a view on immigration. It's not our job to have a view. So
nor would he ever come.
We take that as completely, it is what it is. We take it as it arrives. More, I'd say, stronger policy than most people had expected. we've seen, very sharp decline in growth of the labor force and in people entering the country. And yeah, I think you're only beginning to see the strength of that policy too. There's more expulsions; those are rising, and that kind of thing. So yeah, that's a big economic factor. So that will mean fewer people to work
for in the last election.
You have anecdotal evidence of industries that are just having a hard time finding people. You don't see it in wages or anything like that at this point. You don't see, at least in the aggregate, you don't.
Sure, Powell, what's
but yeah,
your
it's going to be a really
number?
important economic fact because that's new people who come into the workforce. They create their supply, but they also create demand. They create their own demand, and
self-sustaining economy.
Again, from our standpoint, we're just our job is to achieve maximum employment or maximum sustainable employment. And that will depend both on the supply of workers and the demand for workers.
Sure, Powell, what are
back
the 12
to the balance sheet? Some questions. Again, I'll kind of try to group these together around mortgage-backed securities and housing affordability. Again, not directly part of the dual mandate, but would the Fed ever look at any specific actions with regard to MBS to address mortgage rates or affordability for housing?
The answer is, look, we look at overall inflation and we don't target housing prices. And also I don't know how you would, we would certainly not engage in mortgage-backed security purchases as a way of addressing mortgage rates or housing directly. That's not what we do. We do have, as I mentioned, a very large amount of mortgage-backed securities, and they're running off, but they run off pretty slowly.
Fair. Question on the beverage curve.
Now you're
Maybe that's not a lightning round question, but let's try it.
Curve.
So do you think that the shift in the beverage curve is a structural shift or just a blip?
I think it's, you're at a place where, further declines in job openings might very well start to show up in unemployment. You've had this amazing time where you came straight down but I just think you're going to reach a point at which unemployment starts to go up. And we haven't really, we may be hitting that now, but it's been remarkable how that line just comes down. And which has been, really a great part of the recovery.
All right.
Okay, yeah.
Well, we have just a couple minutes left. I think we'll end with maybe another sort of philosophical question. Michael Barr spoke to the policy conference in 2024, I believe it was, and he gave some advice to economists.
I thought we were getting beers, boys.
What would your advice be to the economists in the room in terms of how we can best serve the challenges that are facing us collectively in this moment?
I'm inclined to say keep your heads up. It's a time when people are challenging expertise, and I think it's a distinguished profession. It's a very high order profession, and you should be proud of your work and keep at it. Ultimately, we're learning about how the economy works and how society works. Our understanding is so basic and so uncertain, really, still after all these years. But you got to think we're making some progress and doing some good, and imposing sort of an analytical framework around the kind of decisions people make about the economy. So I just want to give you a vote of support and say keep at it.
And likewise, 𝐒𝐈 supports you.
And we support the beverage curve. Their audio went out. Literally, their audio went out. There it is.
Are we done?
Are we done?
Thank you so much.
Thank you.
Are we done? Thank you.
Thank you.
I think they switched audio sources.
I thought we did, but maybe not.
There we go.
Dude, what is this? Then they rewind. All of a sudden, the feed is back like 30 or 40 minutes. Check this out. What is happening? This happened a while ago. What?
Thank you. Thank you so much.
Is this a simulation? No, okay. Maybe there's did the exact same handshake in the exact same spot again. Wait. What is happening? This is still the same live feed.
People had expected.
Huh.
We've seen, very sharp decline in growth of the labor force and in country. And I think you're going to see that more assumptions are rising. That's a big answers overall inflation and which and we're getting now, but it's normal how that line is, which has been really a great part of the recovery.
Us collectively in this moment.
And keep at it. Ultimately, we're learning about how the economy works and how society works. Our understanding is so basic and so uncertain, really, still after all these years. But you got to think we're making some progress and doing some good, and imposing sort of an analytical framework around the kind of decisions people make about the economy. So I just want to give you a vote of support and say keep at it.
And likewise, 𝐒𝐈 supports you.
Now watch. This is still the same live feed. The audio goes.
Thank you so much.
Thank you. Thank you.
Are we done? Thank you so much. Wait. Why is it going fast now? Playback speed normal. Now it cuts back to earlier. I knew this was earlier.
Camera somewhere?
I thought we did, but maybe not.
There we go. We don't have a camera. There we go.
I guess they could be doing this again. I thought he was going to then pack his stuff up, and I was like, oh, that does make sense. Okay. But I don't think that's the case. Look what happens.
Thank you. Thank you so much.
No, that has to be wrapping up. That has to be different. But then watch. Start skipping some more. I'm trying to find my chart I just had up. I was looking at that. No, this is from before. What is happening?
Enjoyed my regular.
Is he doing like a closer? We just missed it. It's hard to tell. What's up, Jess and Michael Cal? Thanks for the super chat, Alex. So crypto, love you, bro. What's up, Arc Street? Ethan,
Thank you,
everybody
Emily.
who subscribed, keep subscribing.
And thanks to the National
like,
Association for Business Economics for the Adam Smith Award. It for me is an unexpected honor just to be mentioned alongside many of your past recipients, including particularly my predecessors, Janet Yellen and Ben Bernanke. So thank you very much for this recognition. I will say on a more personal note, I have greatly enjoyed my regular visits to your annual meeting and your conferences. It's really been my favorite venue all these years.
What already happened.
It's a place size of our balance sheet.
What? What? We were joking kind of about it being AI. I mean, it was really bad and it was really glitching out. It was kind of AI-ish. I was joking about it, but what is this? There is no camera cut. There's no cut. There was no like there was a cut. I mean, it cuts right here, right? But there's no transition. Why did this just loop back after the audio turned off?
Thank you so much.
Thank you. Thank you.
He sounds really weird.
Thank you
there.
very much.
Camera somewhere?
I thought we did, but maybe not.
There we go.
And then it cuts back to right here.
There we go.
What the hell? What the hell? What the hell? Like right there.
And lasting impact.
What? That was.
Thank you so much.
That was like 50. That was like 30, 40 minutes ago.
And only the Fed can create them.
What in the hell?
The adequate provision.
All right, I don't know. I think that confirms that he's AI. I think that it's all AI now. Everything's AI. Have you guys noticed, is it just me, or now like almost any time that you see a video and someone's like just delivering like a little speech, like a little statement, right? Anytime now, if someone's doing that and they're in a room by themselves and there's like really nothing in the background, I always am like, wait, is this AI? It just feels like AI now. I don't know. I'm AI paranoid at this point. A paranoid eye. I can't find the thing I started with. Where is this? I'm like flashing through these, giving you guys all kinds of, there we go. Flashing through, giving you guys all kinds of disorientation with the charts. I think Bitcoin's looking to break a little move to the upside. Not a lot's going on. Not a lot was said there, but we did cover it. We almost didn't there. They almost had us. They almost had us, those tricky bastards. I assume everything. I assume that I'm AI. Guys, if you think I am AI, you're wrong, but someday you'll probably be right. Someday I probably will be AI. And you know what? You'll never know. You'll never know when. Turn off the stream window. Thank you. Good reminder. You'll never know when. I won't let you know. Our AI overlords won't let you know. It'll be too late. They'll just transition us. They'll just sunset us. God, that's a horror movie waiting to happen. Where is this source? Why can't I find it? There it is. They'll just sunset us, and all of a sudden we don't even know. We're just gone. Your favorite streamers are just gone. Yeah, I think Bitcoin's looking to break to the upside here. Interesting. Let's go over really quick, just a few quick things that we saw during this live. I couldn't really speak during it the way we usually do because there were just no breaks. We never see 𝐒𝐴 speak like that. Typically, he'll do the kind of keynote intro to the FOMC, and that's like 7 minutes, and then they go into Q&A, and he maybe has 1 to 4 minute answers. You know, we never hear a solid 20 plus minutes of 𝐒𝐴 going. So that was weird. It was weird. The audio and video quality were terrible. Wait, I digress. I'm getting sidetracked. The cool stuff we found kind of during the side quests of that I couldn't really yell about. We did fill the CME gap. You guys saw me tweet about that at Tom Crown Crypto on Twitter. Go ahead and follow me. I'm going to drop that banger of a tweet. I'm going to drop this banger. I'll get to that in a second. We filled the gap. It is slightly open, but I think it is pretty much fair to say we filled the gap below on our move down today for CME. Now, interesting. This is actually the alpha. If you've made it this far, you're getting rewarded here. Don't go anywhere. Keep hyping it up. Keep subscribing. This is the value, the pot of gold at the end of the rainbow, if you will. There's a new gap above us that I actually didn't catch until right now. 116.9. That is a number that if you have tuned into this channel regularly over the last, I don't know, month or so, you'd be familiar with. That is a number that we have been watching. Where's this chart? Where's the chart? A number we've been watching. Where are we? A number that we, in fact, more than watched. It was in September, I suppose. I opened a short here. And I foolishly, guys, I don't LARPy, I don't lie, there's no reason to fake trades or pretend I never lose. You guys saw me decide to close it up here. I wrote it down. I saw it go up. I actually would have kept it open if I didn't stop it. It was just one of those bad choices. You know, we're all human. We hit all-time high, and I decided to close it. I said we're going to keep going, right? It was from 116.9 right here. That is where the new gap is. There's a reason that we're looking at 116.9. I will have to find it again. You might have to give me a minute. I think actually it's on the week. There's a lot of numbers. 116.9. Where was it? Where did we get it from? Damn. I might have to go back to the stream. I know there was a bunch of confluence there. There was a very good reason. I was looking for that short. Was it here? August. Damn, I might have to go back to the playbook and check out all the reasoning for it. It's okay. If you guys remember, feel free to share it in the chat. But we are back with a CME gap at 116.9, and again, 116.9 may be an opportunity to go short. This was kind of the 𝐂𝐴 top of this move in September. It did get wrecked, but that gap opening, I think, is actually a very spicy place to look for a little hedge. Now, do we want to be more patient? Probably. We are battling it out with our VWAPs here on the month from Q3's VWAP. We also have from July, but Q3, we have August, we have September, October. The only one really diverging here, all of the weighted price, all the weighted average price. So the average price of all the Bitcoin bought and sold in this time period, right about here. All converging. This doesn't happen that often. All converging right here at 115.3. We talked about this potentially rejecting, but certainly acting as resistance. We did see that already today. We came down and we filled that CME gap. The move back up, 169, I think is looking good now, and obviously a close above these VWAPs is going to be a great signal for that. But at that point, I feel like you just want to be patient. You're probably aiming higher and looking for this October to come down. Now I'm just vibing. I'm going off on the tangent. We have a few things that we also looked at that I wanted to share. Gold's going to new all-time highs still. We're going to 5,000. Still think by the end of the year. Doesn't seem to have slowed down at all. Silver has pulled back ever so slightly, but to fade silver here, I think is just a joke. I don't understand a world where silver doesn't go to 100. Honestly, it could happen by the end of the year, but I'm not going to say that because that's crazy for metals. I think it's headed there very realistically. there'll be pullbacks here and there, not just only up. We're seeing that right here today, but silver looks absolutely primed. I don't know why you'd bet against it. I'd say the best and biggest alpha that we did catch live today that I want to update you guys on, ETH and ETH-BTC. So we had these trades placed long ago. I almost gave up on the ETH-BTC trade, actually. I almost gave up on it. Back here in mid-September when we started bouncing, I was like, oh, maybe it's not going to fill. But we did see on the sell-off both our ETH-USD fill at 3,750 and ETH-BTC, this is more importantly, backtest the major previous resistance, 033. This was the final piece of the puzzle that I've been waiting for and talking about to make that move up to 0.05. Now, this isn't looking super bullish yet, other than the fact it's bounced from support, but we stumbled upon something here. If you go to the 3-month period, which you might say, why would it be on the 3-month? Because that's actually where 033 came from, whether you are aware of that or not. Yeah, that's the old magic. That's the old lore. 033 came from this time period, but we go to the 3-month. Obviously, there's reasons up here. This is untested resistance, lots of liquidity, whatever. But I caught this during the live on Market Cipher B. Shout out to Market Cipher. Link in the video description below. Market Cipher B, one of my favorite indicators. You see me use it every day here. This is not something that you see often. In fact, you can see all the way back here. We don't even have data. This takes time to generate. It takes candles. You need a lot of time for 3 months. We're getting a green dot down here. Now, nothing in trading is as easy as there's a green dot, money, number go up. But this is definitely a welcomed sign combined with looking for that move to that 0.05 and the nice clean back test of 0.33. That is hard to ignore. Now, this is the freshest candle, meaning the current candle has the green dot. Until it closes, it's not really validated, meaning if Ethereum, ETH-BTC sells off, we could see that go away. But I think that's very unlikely at this point. I don't see that catastrophic move coming in this quarter, maybe next quarter. But right now, I think this is primed, and this is actually some serious alpha. I really like that. Really like that setup. I'm not sure. Do we have anything else that was actually good? BNB, I mean, it apparently is just like unstoppable. BNB is 1500 next, I suppose. Sure. ZEC trade filled. It's actually looking a little weaker than I expected. And we checked this out on yesterday. ZEC BTC actually maybe giving up a little bit, at least short term, having a little exhaustion. We can see a zone here of resistance on the other BTC pair. And if you zoom out, it has been a very, very tough journey for ZEC. Similar to all the coins, though. Realistically, similar to all the coins from that time. But entering into this resistance zone, we pointed out yesterday, that is maybe the little weakness we're seeing on USD. I wouldn't quite count ZEC cooked at this point. I still think we're going to see 400 on it. We'll see what happens after that. But interesting to see that slow down on the BTC pairs. This is really just another example of how important it is to be paying attention to these BTC pairs, especially in coins that are just running. Coins that are blasting off, really pushing through USD values. Flip over to the BTC pair and you might get some insight as to how much is left in that tank for the rally. It's interesting. I'm going to put another alert here. Was there really anything else? Dash. Yeah, we looked at Dash as well and kind of came up with the same scenario. Dash already cooling down there. I honestly wouldn't even be surprised if Dash sells off underneath 41, or at least fills 41. Looking for our trade here. I should post these in the Crown Crypto group. Join crowncrypto.com if you're looking for one-on-one crypto. Not even crypto, just trading. Mentoring with myself. Do I even have like the button for that? Cool. I think that might be it. We're going to be live again tomorrow because it's Wednesday. We're live Monday, Wednesday, and Friday here. Today was special for Chirpow. I appreciate everybody who tuned in, everybody who hyped it up, everybody who, I don't know, subscribed, joined us. Last piece of ever. So I rarely tweet like this. I'm not a drama guy, but this is a genuine feeling for me. I'm just like sick of watching people on Twitter go after Benjamin Cohen. Basically just to clout farm him. Like, just going after him after like literally all these, especially the people going after him are the people who have just like shit on him publicly for this entire cycle. And then now that he's right, I don't know. I'm sick of it. So I decided someone needs to throw their hat in the ring a little bit here, because you guys know I love Ben Cohen. We see things eye to eye a lot of the time, the majority of the time, not in everything. But we also, similar looks on the space, similar analysis types, and he's a friend of mine. So what do you guys think about this tweet? Can I make it better? I like this picture. I mean, it's really just an excuse to post this picture from his party in Vegas. I just feel like it's the perfect level of sass, and it's something that needs to be said. This is the truth. These people that are going after him have just gotten like themselves and their followers like so wrecked over this time, and then they're just going after Ben because I guess they have nothing else left. Like, I don't know. I like it. Nice done. He's a good guy, dude. He's such a good dude. Like, I don't know. He has so many people going after him right now. I feel like he needs at least one tweet in his corner. And this picture's fucking fire. So, is what it is. All right. I don't know how I can improve it. I think it's pretty perfect. Great stream. Thank you, Don. I don't know what's going on with this. Why are we all these ats? So these ats are your tag for your channel, for your YouTube channel, whether you know it or not. If you're chatting, you have a YouTube channel. So mine is @TomCrown, but yours doesn't have to be the same as your name. And for some reason, YouTube has decided for the stream not to use our real name. They use our tags. I don't know. I've seen it before, but I don't know why it's doing that. It's weird. All right, with your permissions, with your approvals, I'm going to post this. I'm going to post this right now. I like it. Like farming on his calls. Oh, yeah. Boom. I never tweet stuff like that. But I think it's genuine. I feel that way. I know it's going to piss some people off. Go give it some love. Give it some engagement. I know it's going to piss people off. It's going to get me a little negative attentions, but I don't care. That's what Twitter is, and that's why I never grow on Twitter, because that's all it is. All it is just people being toxic. Anyway. This was an interesting stream. I think we've confirmed here that Powell has been replaced. As you remember, he was pre-recorded his last speech. He's been replaced by AI. 64% of us said yes, 2,000 votes. And we're going to find out because the FOMC is just in a few weeks here. I just scheduled it during the live stream. And when this ends, you're going to be redirected there. So definitely tune in tomorrow, but absolutely tune in for the FOMC. We're getting another rate cut. With or without the government data, we're getting another rate cut. That's what I interpret, as Powell said today. Set up with our exchange partner, BYDFI. Links in the video description below. And yeah, I will catch you soon. Thanks for tuning in, guys. Have a good one. Bitcoin looks fine here. I mean, a retest of 115.3 looks very good. 116.9 for that CME gap. That actually might be 115.3 because CME is about 1,000 above. Anyway, I think it's looking good. I like this bounce. I think things look fine. I'm not worried. Take a deep breath, relax, do yourself a favor, and chill out. Go do something fun. Love you all.